Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, May 10th, 2024. It's 2:22 p.m. Eastern Time. I'm started the video. I think somebody corrected me. I may have said Thursday at the start of the last video. Thank you for the correction there. I told you my head was a little out of it this morning. Having to put the family dog down, but that's over, out of the way now. I'm going to do one video. This will probably be the last one for the week. And here's what we're going to cover. A very, very brief update on the equity markets, followed by kind of what I've been focused on lately, just that asset allocation mix, the, both trade ideas as well as, even if you're not trading them, kind of things that may impact one or the other. In other words, how bonds can impact, and most certainly do, the market via interest rates, commodities impact inflation. And so we're going to go in this order after the equity markets. Kind of just have it scratched down in random order. I want to update the grains certainly today. That's one sector we've been long and bullish on, or I've been long and bullish on, highlighting crude, natural gas, Treasury bonds. Brief update there. I already did an earlier update today. And then again, I mentioned GDX earlier. Somebody asked about an update on GDX. I'll get to that. And then looking at the charts today, one stood out to me. I'm going to show you something with similar technical posture, also a trade idea as well, potential trade idea, and that is AMBC, one of the big bond insurers. So sounds like a lot, but let's do it pretty quick. We're not going to spend a lot of time on the equity markets, because here's what we're going to do. We're going to close the week on the downtrend line off the highs. This is QQQ. To me, the most important index right now. And so that's it. So I don't, from this point, we only have an hour and a half in the trading day. They can rally it and park it around today's highs, or they can take it down below to today's lows. For all intents and purposes, we're going to close right on or in close enough proximity to this downtrend line to say that it's still not been taken out. And again, that is the downtrend line off the highs. You've got a lot of clean, distinct reactions, including this one. I tweaked the trend line ever so slightly. I might have had to come in lower, but when you look closely, it is perfectly aligned with these top of these all of these candles here, the highest part. So you've got 1, 2, 3, 4, and if you bring it down if you want a little bit lower, either way, we're in close enough proximity. So that is the market. So to be continued next week. Before I leave that, let me just flip over to a different board and show you something here. Okay, all the time I talk about, providing technical analysis. I'll use words like maybe, probably, and almost certainly. Obviously, those are varying degrees of confidence. Something we may go up, may go down, most likely will. That most likely is, well north of 50%, and or likely, quite likely, most likely, or high probability is that's when I use those terms. That's like 80+% chance, in my opinion. And so that's how the market is. There's no guarantees, but what I can tell you, certain things I can tell you definitively with 100% certainty. And what I can tell you, and I have been for a while, but just to make it clear, back here, that was the biggest, was first considered by many the first bear market since COVID. If you want to even consider COVID a bear market, even though it was 36% drop. And what I can tell you with certainty, we had almost an identical technical posture. The market was moving up like it is now. Here, let me go back then. You can see here we were making lower lows on the indicators. That is your divergence line up top from this point on. The divergence continued to set up. You can zoom in. You had little shorter term. Let's see, the divergence really steepening right here. I'm trying to grab a line tool. Software always gives me a little hard time with that. That was actually, I should have took that line down. Was that it? No, I have it correct. So you can see there, you have that little drop off at the end there, a steep divergence. And what that is, that's indicative of that the final thrust up, that final buying climax there. And we pretty much made a double top high. That's where your volume spiked. You can't see it here. I'll show you. This is where the average volume was here. There were a few other bars. This was the highest spike. And that's when the S&P peaked right there. So technically the Nasdaq made an ever so slightly lower high. Call it, for all intents and purposes, an equal high right in the beginning of 2022 when the SPY peaked. And we had a clear, buying climax on there. We don't have that yet. I've seen plenty of tops come without a buying climax, and plenty of bottoms come with or without them as well. But again, let's just speak certainties. What I can tell you with 100% certainty, we had divergence building for many months leading up to that high. It was actually over a year long. And then the divergence played out. We had early sell signals there. We had a kickback rally, as I've discussed recently, that came all the way back almost to where the Nasdaq peaked. Made pretty much anybody that, second guess if they were, positioning for this. I had laid out targets at the time and given you those. They're not even shown on this board. Long-term bear market targets, which I think the third of which was hit when we reversed. And that's that. So what I'm doing is comparing then to now. And so now what I can tell you again definitively, I can't promise you where the market's going. I wish I could. But I can promise you that we have comparable divergences that have been building. And they're not the be-all, end-all, but they're a very accurate predictor of trend changes. They indicate an impending trend change is likely. And so you can see them there. That's it. So up to did I get all the way? No, I have to bring that line over a little more. This is a board I don't use often. I flipped over to this, what I call clean board here. So it didn't have all the lines. It's not so clear, so you can kind of see the bigger picture. And then this is that target I still have on the Qs down here on the day here. There it is. Boom. Go back here. Nope. This board here. There it is. T3, T4, T5, and so you can see on that other board I just toggled to, there's also a trend line, a potential trend line, I should say. I say potential because you only have two distinct reactions now. It's right in line roughly with the 200-day moving averages, and every so often, even in a bull trend, the most bullish of bull trends, the market, when it gets too far away from that, it's like gravity, it's going to pull it back to it. And then once it goes, then it tells you you're most likely in a bigger primary trend change with more downside to come. Then you can start shorting any kickbacks to the 200-day moving averages. Again, I'm throwing out, being very specific with this. I almost expect and favor a slight brief slice through them. Quite often you get that. You had it here. But we'll see. And again, first of all, we'll see if right now we're, like I told you earlier today, we're at a key inflection point. We're at major resistance there. Now I'm going to change over to bonds. Oh, well, let me do small caps because I sometimes forget. I've been talking about small caps for a while. Being the other index that I like, for swing short potential. That put in that divergent high, breakdown, back test, hit this key. It already hit. There's a good example. It hit a perfect, almost perfect 200-day. The red line's your 200-day exponential moving average. You had the 200 simple just below. The simple will only responds a little slower to prices. That's exponential, calculates, it uses a faster calculation period, so it tends to move a little faster. And again, I always say I keep them both on my charts because some traders use one, some use the other. Therefore, I'm going to look at them both. Breakdown, back test, snapback, rally, and we'll see. So and again, big divergent high, just like you had here. Oh yeah, and I'm speaking of similarities. That was what we had leading up to the top right here before the bear market started. You had divergence spanning almost a year long there, many months right there. You had overbought conditions, and here you were overbought there. And that was your divergence line right there. So we'll see. And this is we're still well off the highs. So you wouldn't expect in the small caps to see the same comparable divergence. Usually bear market rallies, if that is what this is, I'm going to give you smaller divergence, just like you had positive, aka bullish divergence at that low right there. And that one as well. And those give you this trading range here. So that's it. Let's move on, or it will be a super long video. I promised you wheat next, the grains. Wheat, obviously, that's been, my favorite, and but I told you recently I added on some soybeans and corn because I tend to follow. So the reason I wanted to do an update today, so forever and a day I've been talking about this T1 back here from the, we had trade entry back here. T1 hit again, T1 hit again, T1 hit again, and I told you sooner or later it's probably going to pop out, and it did that. It still has divergence, but look at this as I said in recent videos, the signature of a bull move. I'm going to put a little, maybe an uptrend line there, and we'll see. But a signature of a bull run is divergences will play out for very little, even if any of a pullback. Sometimes just as start to pull back, they buy it up again, and then ultimately, so what you want to look for here on WAT, and if time permit, I'll get to the futures. I'll probably just cover that next week. You want to see those divergences taken out, and then that's quite bullish. But what I can say, price comes first and foremost before anything is price action. And I can tell you T1, and we're slated to close above it now, about 607 here on the 60-minute chart. And again, you can see it on the daily chart. Remember, we hit T1 right here. We had this recent divergent low. I highlighted here as either a new setup or an existing if you've been in wheat for a while. Breakout, we hit my first resistance and a big resistance to that, 551. We had a back test, powered on through. There was the breakout. So you had the downtrend line breakout, R1 breakout, which is very powerful. Went up, hit T1 almost perfectly, pulled back as expected, and now have powered on through there. And we're clearly putting, at least here I have it at 596. Yeah, on the 60-minute I had it at 604. So we'll call it 6-ish. Bottom line, it's incremental, guys. Every tick away that we can build. Now it's going to stop trading. I think it probably just stopped trading for the day, the wheat future. So that's probably all you're going to see today. Remember, wheat and all these agricultural commodity futures going to have quirky trading hours. So that's it. So there's a potential uptrend line, but again, this is all nothing but constructive price action, up 2.84%, heading towards T2. Not close enough that I'll consider it hit. Yeah, I'll tell you what, the high of the day wasn't far from it. I mean, you could certainly have taken profits, but I'm sitting tight for now. 618 versus the target of 624. All right, so let's just look at the others and we'll move on. Corn hit T1. Pulled back to that 2022 resistance. Remember, that was a level to trigger a second buy signal. We broke out of both downtrend lines, back tested, and then breakout, hit T1, pulled back, gave you an objective re-entry or new entry if you missed it, or add-on back at 22.21. And we're right back there. So we've got this little period of consolidation. So pretty much, even though T1 I had it to 2069, we need to punch over the recent highs, and then that should open the door to T2. You can see right here and all the other targets potentially. And then soybeans, SOYB, tends to run with it. We already hit T1, had our typical reaction, pull back. And so same story. If it can power over that recent high, it should open the door to those other targets. And those are your grains. Yesterday I shared some of the fertilizer stocks that I like too, that tend to move once it becomes clear to the masses that the grains are rallying. And so far, just like wheat and corn, you have the early makings of an uptrend here. We'll see. Could be an ABC corrective wave, but again, let's see if we can take this level out. It'll start to firm up the outlook for soybeans. And in the bigger picture, you're in this big trading range, and ultimately if we can punch through there, which I think is possible, that's going to be quite bullish. And remember, guys, these are ag commodities. I always say this: oil has the biggest and most direct impact, not only in the weighting to the CPI, it's one of the bigger components, but it's also priced in. It's almost instantaneous. Whereas soybeans, corn, and wheat go up, Pillsbury isn't going to raise their prices right away, or General Mills. It takes a little while to those prices get reflected in there. But however, it is net inflationary. I mean, there's got to be some folks watching this and say, oh, well, the grains are going back up. It's not going to help the inflation costs. Okay, let's just all agree on that. So whether it's immediate or lagged or not. All right, that brings me to, let's just loop over to the energy since I'm on commodities, and then we'll go to the other stuff. Okay, just yesterday, crude oil hit the first price target. That was this was the original chart with the setup, highlighting it as a long, anywhere from 78 down to, but not below the trend line, with an ideal entry, even stated at the time, to see a move all the way down to the trend line. We hit it perfectly. Can't ask for a better entry, and so far played out perfectly. Rallied up, hit the first target there, 79.81. Expected a reaction and another thrust up. We haven't had the thrust up, but we certainly got the reaction, and that's why I'm highlighting it for you today, because here we are. That's the hit of 79.81 target where a reaction was expected. If 77 or roughly 78 was support before resistance, then it makes it now support. And so I think it's an objective time to enter crude. I think that's the first leg up, first corrective wave, and still maintain the next target, a minimum, a down move up to the downtrend line. And again, stops are going to be relative or commensurate to where your entry price or prices is. If you're scaling in, ideally you do want to see it stay above that trend line. So not going to be, it's hard to spin it as anything but net bearish. But if it does break the trend line, I'll look at the charts. We'll look at other things as well and see if it's time to either add to it or let it go. All right, but there's your update on crude, playing out so far as expected. Natural gas, I don't expect as much of a reaction. Very little muted so far. You have pretty powerful divergence. And again, same story. Is that divergence going to play out for the end of the run? But remember, we're coming off a much, much larger positive divergence. So these are, what I call offsetting factors. I will give a higher weighting to the fact natural gas, even though the price seems to be, just slogging around recently. But we did take out this trading range here. You can see there, you've boxed it in where the top of my T1 was. Remember, we were highlighted to go long here on or off that 1.925 support. Also, you had a breakout above the downtrend line, breakout in a back test. And so far so good. It's walking its way up. I may tweak this trend line here to come in and capture that more recent reaction low right there. We'll see if that develops. I'd like to see another reaction to help validate it. But either way, the same story. If we do get a pullback, maybe we get more of a pullback than I thought because of this divergence right here. It's certainly worth noting. Support levels, that's a pretty big one. I can tell you right now, I will most likely reconsider whether I want to hold or add to. I won't be adding to. If we go down below, I'll probably be stopping out. But I'm going to sit tight now and ride out, even though I see this negative divergence based on the bullish price action, technical posture. But this level here, really, that should not. That's about 214 because, again, it was the top of this trading range. Ideally, you want to see any pullbacks contained there, but I will continue to do updates on that gas. And that fact we were long, we had another long trade back here. I believe it was right here. And the same thing, I mentioned a stop, or was it back on this one? I don't know. I trade natural gas all the time. Dozens and dozens of trades a year. And, I've been, highlighting these divergent lows and rallies. And so it's quite often these uptrend lines that when taken out, you can see you get impulsive selling and the trend changes. And boom. Boom. And so this one's still not even valid, right? Because we only have two reactions. These had more reactions on it, at least that one if you come in there close enough. And of course, few ETN traders, UNG, same thing. We had the divergent low here on support, multiple tags of that support level. There was that breakout back there, T1 hit. Pulled back again several times. Finally, T2 hit recently here. We took out T2 on the UNG, but remember, I'm looking at natural gas as well, the futures, and there's that divergence also there. So again, you're coming off a much bigger divergent low. We do have negative divergence, and it could, mark the end of this rally. Like I said, I'm ideally, I think we may come down. I don't think we'll even get down this far. Like I said, I think natural gas looks pretty constructive, and I think there's a good chance I'll come in and start buying it here soon. But we won't know till next week, so I will follow up next week. I just want to point out, if we do go lower, there's your objective add-on buy point, and also if you want to keep stops relatively tight, because this is one that you don't want to let get away from you. All right, that's your commodities update. The big ones. Let's see, what else did I have for you? I talked about Treasuries earlier. Won't harp too much on it. So far, also rejected, just like QQQ has been rejected off the downtrend, or riding on it, I should say. So far, you can't say rejected. We're on it. And same thing, IEF has rallied up to that downtrend line. So we remain in this orange zone, which is still, telling us that rates remain elevated and at a point where I believe they'll continue, if we remain here, to put pressure on stocks. So we'll watch this next week. But so far, the trade there is profitable. I mentioned shorting IEF and ZN, more so meets ZN, but IEF is the ETF version at the trend line the other day, and you can see that was there. So we've been stair-stepping lower, but not anything worth, so I'm not taking profits yet. If it pops above the trend line, then I'll most likely just throw that one away. But I wanted to show you guys this too. So we go out to the bigger picture on bonds. Sometimes I live in the world of the 60-minute charts, I call it, and it's easy to get kind of caught up in that world and then forget bigger picture. So here's the same downtrend line. Remember, we're coming off this divergent high. That was the last divergent high. This is IEF. These are bonds. So what this tells us, and I think most of us know this, we've been in the hottest inflationary environment since the 70s, so about half a century. But that means interest rates have been going up and bonds have been in a bear market. And there is zero, let me repeat, zero, absolutely no evidence of anything remotely close to the fact that that bear market is over. Rates have been rising, and this is just nothing goes straight up or straight down. This is a downtrend. You can see it clearly here. Sure, there's some volatility. We've had great, batting probably 800 or higher on trading treasury bonds, damn close to 1,000 for last year, especially some of these major pivots. But what I wanted to show you is kind of bigger picture because it will impact the stock market. So, again, we're coming off that divergent high. Bonds could break out here. This is IEF, so this is the 10-year bond. If it breaks out and starts to run, that means rates are going to go down. And if that happens, and it's just with natural organic forces, market forces, then that should be net bullish for the stock market, and it could support a scenario of new highs, seeing QQQ break out above that trend line and then make a run at and probably take out the previous highs. However, if bonds go up because of nervousness in the stock market, institutions going into what they call flight to safety trade, buying treasuries, and that's the cause of treasury bond prices going up because they're buying the bonds, and that's buying pressure, demand, and that could cause rates to fall. So like I said, there's two, and they're actually they're opposite scenarios. So we'll watch that, and we can ascertain from the charts what's going on in the stock market and what the news is and all that as to which one it is. I just wanted to say that's all maybe and what may happen, but I can tell you definitively that IEF is in a downtrend, right? Even near term, right? In the bigger term that I showed you, the longer term picture, but also intermediate or near term, and it's at resistance. That I can tell you with a 100% certainty. And it hit that resistance yesterday or the day before, and it's still below it. And so therefore, the odds favor it can continue lower. This trend indicator, the PPO, is bearish. It's below the zero line. See? And that's when it's below the zero line, the trend is bearish, and that's what you want to recognize. When you're above the zero line, the PPO, the trend is bullish. And we were long bonds right off that low right there, and we milked most of that move up. Then we turned around and shorted them via TLT. All right, so that's it. I just wanted to impress upon the fact that that's what bonds look like. And so if this happens, there's no spin, by the way, even though I gave you kind of almost polar opposite. It could be bullish if bonds do this for the market. Again, for the reasons why, natural organic abatement of rates, or even Fed induced, but there's no panic selling in the market. The market takes as bullish, or panic selling of equities and institutional buying of bonds. However, let me be very clear, I see no bullish scenario for this. Bonds go down, that means rates continue to tick up. We will move back further down into my orange zone and possibly in my red zone. And I can tell you with the highest degree of confidence that I have, if we get down here, the stock market will freak out. All right, there's and then last thing, guys, one more. This is important. This is kind of, again, big picture stuff. TNX is the yield of the 10-year bond. And so, again, it's looking at bond prices in reverse. This is interest rates. This is what happened since COVID here. This is the Fed denying, inflation was just transitory. It's not. And so then it wasn't. But no matter what, this is the trend in interest rates. All right. And there's absolutely, again, no evidence that trend is over. And so I just want to point that out. And we know that the market has been increasingly sensitive and will remain so. We have a massive amount of debt coming due, corporate debt, over the next, both this year and then the coming years, this year and next. And the market has been betting hard that they're going to be able to roll at lower rates, that the Fed was going to come in and cut. That's why the market has been cheering bad news lately. And again, this is bizarro world. I'm not going to go off on a tangent too much, but when you have weaker, employment numbers and weaker GDP and weaker, industrial production, all this stuff, and the market actually rallies on that, again, all I have to say is be careful what you wish for. But it's what happens every time. Um, but more than ever right now, the market is just completely addicted, like a really bad heroin addict, completely addicted to low rates, and it'll take about just anything, um, any excuse to rally on the hopes that rates are going to go lower. So I know I'm talking on a lot, but it is everything right now, guys. So here's the bigger picture on TNX, by the way. We did have, there was a divergent high on yields, big divergent high, and they moved lower. So far, it's just been an initial thrust down and then another thrust up. So what I can tell you definitively here is that I have this uptrend line right here in purple, and we broke that. We've been back testing it from below while riding up this uptrend line. So this uptrend line, this minor one, is exactly the downtrend line that I gave you on IEF and ZN, the 10-year Treasury bonds, the futures. Because remember, the yields are the bonds in reverse. And so this is it. Now, that's my daily chart, and I can make a case that yields have peaked based on that. Remember, we went long Treasuries right off that high, and then we turned around shortly after we booked the profits on Treasury TLT, which was going up when yields are falling. We put it on as a short. But let me show you a bigger picture here, and this is kind of what I'm leaning towards and have been. This isn't anything new. I've shared this in the past. This goes back as long as you want. This is as long as you want to go back. This is when interest rates peaked in the early 80s. There was our inflationary period in the 70s into the early 80s. Out goes Carter, and comes Reagan. Volcker destroyed the inflation dragon. And then, boom, we had this clear downtrend line, and that downtrend line was taken out there. So by every metric that I have, we had, it was set up. This was a divergent low. This is where the Fed completely, and if you have enough money, if unlimited, the Fed doesn't, there's no limit. The Fed they make the money. And so they printed, and Washington stimulated. So that was, in my opinion, when the what I call Ursa interruptus, bear market interrupted. That's when that secular trend in rates should have ended. Each of these big drops were the big rounds of quantitative easing, and then the massive nuclear option there. But okay, so whatever. What I can tell you definitively, we've taken out the downtrend line, the previous highs. So I'm still of the mindset that we ended one of the biggest secular bear markets in interest rates in years. That's almost a 5-decade, 40+ years of declining rates, and we're on a new secular bull market where we'll see rising rates over time, and it's not going to be a straight ride up. I plan to continue to have a field day trading bonds long or short. I might share and talk about my longer term outlook like I do on the stock market, but that's not how I'm going to be positioned at any point in time. I'm going to be positioned based on the shorter term charts. But this does matter because what I can see here is we had this divergent high and we took out that trend line. That's what I showed you on the weekly chart. We had that first leg down. Just kind of from experience and looking at the posture of the MACD and everything that's gone on, I favor that we come up now and we make another bigger divergent high. In other words, that rates take out the previous highs. Those are multi-year highs. When we hit that high recently, we have to go all the way back here to the financial crisis. That was the last time interest rates on the 10-year got this high. And so that's kind of the scenario that I think is the most likely. And that's what I wanted to share with you. And again, I can all but give you, I can give you my highest degree of certainty. If that happens, if the market, interest rates take out those previous highs, stock market ain't going to like it. It's just I can't think of a scenario where it's going to somehow allow stocks to continue higher. So we'll see. And it hasn't happened. But again, I've just spent 15 minutes telling you the levels to watch where, hey, what? Bonds break that downtrend line, the 10-year. Maybe it's going to rally a little more, and that means rates are going to go down, and that could open the door for a new high in the stock market. Otherwise, if we get rejected, and again, I'm talking about the right here, this is kind of it. It's going to be lower rates. Should be net bullish for the stock market. That'll be higher rates, and then if we take out this, soon we're going to get into my red zone if that happens. All righty, what else do I have for you? That's bonds. Very important. Oh, okay. So let's wrap it up with GDX. Gold, I've stated for the last few weeks, gold, I don't have a strong convictions. It's been dead money trade for a while, and I think it's going to continue that. We're going up, down, kind of all over the place, but really nowhere since the breakout. There was a powerful breakout. weekly chart, we still have, and it may get taken out, but there's still big negative divergence. But let's speak just the miners right now. So this is GDX. Let's go to a daily chart. And what I can tell you definitively is we have divergent high now. This recent marginal new ever so slightly high. We're on a daily chart here. Remember, I threw out a short trade back here for the miners, and that was on the 60, and we still haven't hit. We had 3 support levels I gave you that have to be taken out first. S1, which was right here, hit. S2 was this trend line that was hit, and S3. And so those were the first big support levels. And again, we've been trading sideways in GDX. So we really need to, again, I'll reiterate so what I said back here, take out S3 to open the door to these targets. Now, with this today's high or equal or marginal new, whatever you want to call it, we have even bigger divergence. So the same divergence we had here that led to that correction has not only has it gone away or not gone away, it's grown even bigger, right? Okay, so that's that. And now go back to the daily chart. So again, I can tell you things I think are going to happen, and I can tell you things that I know for an absolute fact. I can tell you definitively there's negative divergence. I can tell you definitively that it's at the same exact level, which is resistance. That's these previous reaction highs right here, right? So we're at resistance with negative divergence. And I can tell you that we went on first and broke this minor trend line. That's the one I showed you before when I threw out GDX as a short pullback trade. And then what happened then, we made another thrust up. I'm sorry, we only had the divergence there on the 60-minute chart that I just showed you, not on the daily. You can see here, no divergence at all whatsoever. So we came down, now we went up, now we have divergence. All the better the setup at this point in time. I know everybody's bullish GDX, nobody wants to hear it. But there's your uptrend line now. And now let's go back to this point here. You had a minor, the steep, better defined. This was the better defined of the two, more reactions. That broke, then we went down, had a kickback rally. This is identical. It's almost too identical, because usually when you see the same two patterns don't always play out, but it's technical analysis. You can look at these divergent highs, overbought conditions. There's just so much identical right now to this technical posture and the price action in recent weeks to this major high there that it's almost uncanny. Now, if they can burn through it, same thing. That's bullish, man. If they can take out these divergences and run, great. But if oil starts moving up, that's going to put pressure on the miners. And you guys know my current outlook on crude oil. That's another factor there. Just wanted to point that out. A nearly identical technical posture. And from there, we had a pretty big drop. And so the miners are still in this big year-plus long trading range here. They're just right at the top with almost an identical technical setup. And then that brings me to the last one. This is just kind of it was on my... You guys remember last year I started a watch list I called the TTW, or Things to Watch list. Those are an eclectic mix of various stocks, sectors, indexes, mostly sectors and individual stocks that I believe are important to the economy, such as ADP and Paychex, the two big payroll processors, FedEx and UPS. Those have always been tells on the economy. All of which, by the way, those two, FedEx, UPS, and Paychex and ADP, have long since peaked well before the market made new highs. And every time they did that in the past, if it was the peak, which so far it is, not saying they can't go on to make new highs from here, the stock market then followed. So they're great leading indicators. So you hear all this blah, blah, rah, rah, cheerleaders coming out with pom-poms on CNBC about how strong the jobs market is. If you really dig in, read up on the birth-death model that they use and it's possible that they are grossly overstating the jobs data, and when the revisions come in, it could be very ugly. And I'm not saying, I can't tell you definitively. I'm not an expert on that, but I've heard people who are experts talk about the shortcomings in that birth-death model. And then at the end of the day, guys, this is what I'm saying is what. Okay, so if it is this record low unemployment, which also, by the way, look at every chart I've told you, when unemployment peaks, we're at levels that historic low levels. When it turns quick. And so all bear markets start right before or right around the record low unemployment. But when you, again, look at ADP and Paychex, and why are they not trading at all-time highs if we have record low unemployment and the stock market's near all-time highs, and we're going higher? So ADP could break out, and maybe it will. Same thing with paychecks. Maybe it will. All I can tell you is this ADP peaked with some pretty strong technical evidence back in December of 2022, and it's been moving lower, and as did paychecks. And that's it. And there's your downtrend line. This is a peak back in 2022, another major reaction high, another one there, and more recently right there. So these are things I look at. If I can take that out, sure, that's bullish. And then you've got 2 reaction highs that'll be even more bullish. Otherwise, if we get rejected and we go down and take out my purple line right there, about 106, then that's going to be quite bearish. Again, why aren't these guys making 52-week highs if we have such a booming jobs market right now? It doesn't make sense. Their business model is just about as simple as GDX. GDX has 3 variables, really. The price of gold, obviously, first and foremost. So if gold goes up 50%, they're pulling the same metal out of the ground. If you freeze everything else, production costs, that's a windfall to profits. So 50% increase in what you're selling without any pushback from the consumer, But their other 2 variables are labor costs, which have been moving up relatively steadily, but not too bad. And then, of course, energy costs a lot to get out of the ground. Where I was going with these guys, they're charging every new employee that signs up for a company, and they've got payroll processing to do. They're making money. So in a rising job market, more people are working, there are more people getting paychecks, and these guys are processing them. So all right, I just want to point that out. It's one of many things that just doesn't jive with the statistics. That's what I used that quote earlier. There's lies, damn lies, and then statistics. Mark Twain's famous for doing that one. Anyways, we'll see what goes on there. So last one, and then I'll wrap it up. So I was talking about the similarities in GDX, and one that's in my things to watch list, which I just went on a tangent on, was this one, AMBC. And I've never seen such a, I can go back in time and even mark this one up. This stock trades so well to the technicals, it's almost laughable, at least my technicals. Everyone has different styles, but this is my style. Divergent high, boom, drop. Divergent low, rally. Divergent high, drop. Divergent low, rally. Divergent high, and then second divergent high, drop. Divergent high here, and DH2. When DH2 means it's just an extension of the existing divergences, similar to what we have on the Nasdaq and the S&P and everything else there. So let's focus on this period. You don't see things like this on CNBC. So this was a trade idea back here. We shorted it right here. In fact, I have the charts for you queued up. All right, there it is, March 16th. It's down on the bottom. I always timestamp my charts. Even though, I had missed it at first, sometimes I'll see something as I'm going through charts. I'm like, damn, I wish I saw that earlier. It was a beautiful bearish rising wedge, just like this one there, just like that bullish falling wedge. And so anyways, but I got it out to you and said, look, now, although it's well below the wedge, I still think there's enough meat on the bone. I gave you 3 targets at the time, 1309, 1213, and 1120. Then the next chart, the following day, I updated that trade, and said, look, for those that might want to book quick profits, I added a target here at 1411 because we had the FOMC rate decision coming up. There's always volatility around that. So, and I resequenced the other targets. That was the 17th of March. Went ahead, hit that target where you could have booked a quick profit. Nothing big, 4%, but you make 4% in 2 days. Annualize that out, you're killing the market. Next update was posted. There was that T1 hit, and again, to the button, bounced. And so that's where, you can game. And so on a trade where when I get to the end here, you see the whole move, just like the QQQ short trade recently. If you covered on T2 when it was hit and you turned around, reverse long, you turned a, what was an 8% off the post, previous Fed drop into, then, you sidestep the give back and turn that some or all of that into a gain. And so we did that, rallied right back to resistance, offered an objective short. And then at this point, the next one, I know I added a target. Let me get to that. Oh no, I'm sorry. That was on there all along. Yeah, that was the next update. So we got the rejection, and then boom. So 11:20. Here, let me just jump to the live chart. I've got one more. I think it was October, the last update when that one was hit. There it was. So you hit the fourth and final target to the button, and that was then. This is now. So again, shorting this one from the high down to the low, and that's why final targets are there. Typically, it doesn't mean it's guaranteed to reverse, but when I put that in, you've had a run like this down there, and again, all these games off T1, T2, T3, little reaction, and that's what happens. You start to, and that's what I've been talking about QQQ. If we can get down to those levels and take out T2, I'm talking the QQQ trade that we just hit a week or two ago. You start to get, it's what happens is the bulls capitulate, the longs capitulate, and it was after that consolidation around there we had hit T2, hit it again, and then boom, when we just kind of melted down that final thrust, had very few counter trend rallies. So then that's a perfect exit. Now, okay, where's my, I'm not trying to harp on this trade. I'm trying to show you, just like GDX, identical technical posture. Right now, we had back then a divergent high followed by a breakdown, or break of the wedge, a move down, and another kickback. We were already getting overbought and stretched, but we had one last thrust up, blew out the old highs, sucked in some more longs. And longs love bulls, and look, I'll trade breakouts to new highs if it doesn't have negative divergence and overbought conditions. So that was really DH2. You can see that's technically how the line should be, ever so slightly high, and then we went down. And the only thing lacking this time, I'll say this, is we had that first divergent high, the first drop, kickback rally, marginal new high, but still a divergent high. That's why it's DH2. It's an extension of the same divergence that started all the way back here. And diverging, finally divergence started to set in and manifest in the form of a trend reversal. And that seems to be the kind of last gasp here. It's very common, and we saw it in GDX. There's so many stocks you see this. And this is where you usually get those, because this is usually where I start highlighting shorts on whether it's the index or companies like this. And, you don't get a lot of comments, and then you get the first drop, and then they go on and pop and take out that previous high or the short entry point. And then people think it's going to go up forever. But again, I can't make no promises on this one either, but I can tell you it's an identical posture. I would like it better, and sure, you can absolutely take a shot here. You might want to wait to see if QQQ gets rejected off the downtrend line that we're at today. What I don't have on here, and I wish I had for a little better evidence, would be back here you had a clean trend line in which to initially short. However, that didn't turn out to be the entry. The next one was on the divergent high. What I can tell you too, definitively, is we are at resistance. So you've got this divergent high back here, take it across. That's exactly where we just stopped. It's more of a resistance band. So basically this is where this stock for years gets up to and can't go any further. Hey, look, if it breaks out, I'll give you a case that maybe is bullish. You look at the weekly chart, you've got a downtrend line, at least I drew it this way. And this week we're above it. However, we're also at that significant horizontal price resistance. So this is either going to be built on next week, and that's why if you short it, just set a stop. Don't fall in love with it. If it builds on these gains next week and closes above this week's high, especially towards the end next week, then it's probably going to continue up. It will have broken out of this. You'd have a giant, maybe a big old inverse head and shoulders pattern, and that could be bullish, right? This is a bond insurer, but I'm watching this one closely. It's in my things to watch list because I'll end the video here. One of I in my opinion, and I think others might share this, I think we see one of the biggest mispricings of risk in the stock market, at least since the financial crisis, if not more actually, because I saw, and I'm talking about credit spreads. Credit spreads are the difference between what junk bonds or below investment grade bonds pay versus treasuries. And this guy's a bond insurer, and that's in the treasury market. That you look at treasuries versus corporates, but the same thing holds true to munis. I watch munis very closely, and so this market it's priced for perfection. If everything goes hunky dory, we don't see a lot of defaults, and I'm talking both corporate bonds as well as municipalities. If we go into a recession and it's worse, or even right now, there's no pricing of recession in the markets. if we go into recession and it's a bad one, you're going to see quite a few defaults, including municipalities, which AMBAC insures. They insure different type of bonds, and that's gonna hurt them. So there it is. Like anything, take it or leave it. I'll update it next week. I'll try to keep this one on my radar. I'm gonna hold tight and just see what happens next week. I think it's more of a second mouse gets the cheese on this one, but just wanted to point out the similarities. And again, that's what made me think of GDX when I looked at this one, because they both look identical to the last time they peaked, and they're at those same levels too. All right, I will wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.